So there's a number of risks that as you move into the digital economy that need to be addressed. And I would say the first and foremost, as many of us are really feeling in detail right now, is risks associated with human capital. So attracting and retaining talent today is very different than it was 6 months ago. And as we move even further into a digital economy and an agile workforce, there's things that we need to think about that are risk issues that are critical for every organization. So the way that we're training and onboarding new employees has become a risk issue. When we have only learned historically how to do that in an in-person environment, moving that to a digital environment is a different skill set and can be a risk for employers who haven't learned how to do that well. Along those same lines, relationships, getting the culture of your organization ingrained into new colleagues who are working remotely for the first time in a digital environment. Being able to test whether employees are engaged and their level of service to your clients might feel very different in a digital world than it is in an in-person world. Workload and workload balance. I think there's a new discussion that it's not work from home anymore, that it's instead sleeping at work. And so although that sounds a bit funny, I think we can all relate to that. And so I think when we're transferring your business from an in-person world into a digital world, we really need to take those human capital concerns into consideration. I think one of the most important pieces for companies that are moving into the digital world is to not make the assumption that the digital world is the same as an in-person world, but over the internet. The best piece of advice that I could give a company working on their digital capabilities and expanding their scope of operations in a digital way is to meet with your broker and talk about the strategy of your business, not just the insurance policy that you're buying, but the strategy that you're trying to accomplish, and then talk about how you can use insurance to facilitate that strategy. So I think risk managers that are looking through the digital transformation can turn to the insurance industry for some guidance in this space. And I would start by talking about some actuarial studies. So we've got more data with each transaction in the digital world than we've ever had with legacy solutions. But what that does is, in addition to giving you more information, it heightens the expectation that underwriters will have around what you can contribute to the conversation around underwriting for these new business models or these digital transformation business models. So what we can do is help you with actuarial studies. In fact, we have a number of clients in the digital world who would say that they might hire an actuary before they even hire a risk manager, because the data piece is so critical to the success of their insurance programs. We also have an anticipation in this space that both the client and the broker will come to the table with the appropriate strike price for insurance. And what I mean by that is we need to know what the effective transition rate of your insurance will be. We need to know exactly what it would cost you and when it's appropriate to buy insurance and when it's appropriate to retain that risk. Again, we're going to use data to get to that number, but carriers are expecting that we're going to come to the table with a strong negotiation on a price to begin with. It's not always started with the carrier offering the price, as it has been historically. Benchmarking can be helpful. Benchmarking is often a look back rather than a look forward, but still we want to take that information as much as possible. And certainly as we approach this hard market, it becomes even more important to pack as much information into each submission and each conversation as we can. The insurance industry has a very strong role, but I think that that role needs to be in collaboration with each of the new digital businesses as well. We're each learning this business in our own strides together as an industry. So if you've got a business and the business model might only be 1 year or 3 years old, that also means the insurance industry only has 1 year or 3 years to learn the business. I think our best foot forward is often when we're working together and collaborate and thinking through the risk issues. Having said that, when we're building out data sets for some of our new business models or clients that are now forming a digital operation from a legacy business, we can often look at analogous sets of data from other industries and say, what can we learn from this? It might not be that it's a direct equivalent to what we're trying to build, but it certainly helps us to say, let's get some directional guidance from what we do know, and then take some of the new data sets and say, what can we do differently here? We often also try to work with clients to say, let's build an insurance program that's flexible and malleable so that as we're each learning, we're not waiting a full 12 months to make a change or do something different with a program because of information that we learned 3 months in. Let's build something that we can all learn from with active communication. Businesses need to be asking brokers to kind of walk through with them what is changing about their liability profile over what the legacy business might have been, or if they're working on a new business model that's never been into the marketplace before, how will underwriters and others take the liability into consideration? So I think one of the things we can be asking of the insurance industry is to help think through those liabilities, but create an active conversation where it's not a one conversation and there's an answer. There's an evolution in this business. And what I find with many of our digital clients is that they set out to have one business model, and that business model, I think of it like concentric circles, that business model builds a little bit broader, adds a little bit more scope, changes geographies very quickly. When you're in the digital world, moving from one geography to another is so much simpler than in the physical world, but that does change the risk profile. And so I would say, be sure to be asking about what the liabilities are of the new business model, but also keep the communication lines open so that there isn't an expectation that the business model is static or that the liabilities are static or the way they're perceived as static. Lloyd's brings together one of the most creative marketplaces for insurance in the world. And what I've appreciated about working with our Lloyd's partners is that we've been able to build new products that are customized specifically to the clients and the new emerging business models. If we're thinking about cyber liability, Lloyd's is certainly an active player in cyber, both in standard cyber programs, but also in bespoke solutions that are unique to clients that either have a communications risk that is very unique, a social media risk that hadn't been contemplated historically, et cetera. So certainly for cyber. Another piece of the new digital economy that's been very active is mobility as a service. So if we're thinking about rideshare companies, car share, subscription auto, autonomous vehicles, we've really looked to the Lloyd's marketplace to create auto liability solutions that fit this new form of mobility in a way that works for the enterprise and for the riders and drivers, if there's a driver, and autonomous where that's most appropriate. So certainly there's a breadth of auto experience in Lloyd's, particularly in the last kind of 3 to 5 years, we've really seen Lloyd's active in those coverages. Directors and officers liability is of course an interesting one. Lloyd's has a long history in this space. But again, we've been stretching our Lloyd's capacity for D&O as we look to these new business models, and as managers and management of these large organizations are managing different risk issues than they have before, which places an additional burden on the directors and officers and therefore on those policies.